Hello everyone, welcome to the Knowledge Point. Today we will understand all these concepts that is related to your cost revenue analysis in the very simplest form and in a better way. First, one by one we will understand the basic meaning of all these terms, that is fixed cost, variable cost, total cost, average fixed cost, average variable cost, average total cost, which is sometime known as actual average cost, marginal cost, total revenue, and average revenue. Once we understand all the meaning of it, then we will connect that how this all terms helps us to analyze the we can say the point where the company makes the decision whether to continue with something or to stop with something. So let's start with this video, and I hope this video will be very informative to you. Fixed cost basically means the cost incurred by the company on investments and purchasing of the fixed assets, right? Variable cost is related to your production, it is related to your output. When the company produces something, the variable cost is started incurring, which is also sometimes known as a working capital. Total cost is the addition, or we can say the summation of both fixed cost and variable cost. So when you add fixed cost plus variable cost, it is known as a total cost. What do you mean by AFC, that is average fixed cost? When you take total of all the fixed cost and divide by the quantity, it is known as average. And why taking average is important? Average always gives you a midpoint of your total expenses or the revenue or your data, and this midpoint is basically considered as zero. When if you move towards positive side, it shows profit, and you move towards backwards, basically it shows loss. So this average is always at the center. So if you gain above average, you are scoring, and if you gain below, if you lose below average, you are losing basically. So when you take all the expenses related to your fixed capital investment, and when you take average out of it, you get the average fixed cost. And the same way average variable cost. Average variable cost is also related to your output. The more you produce, the working capital, the working cost increases, sorry, right? When the working cost increases, this working cost relates with your variable cost. And when you take average or the midpoint of it, when you go upward, you generate more cost, and when you go down, you become loss, you get loss. So this is the average variable cost. Then we understand this average total cost. Average total cost, as we know, the total cost is derived from the addition of fixed cost plus variable cost, right, and divided by the quantity. So average fixed cost says that all the total cost, when you divide it by the quantity out of it, you get total cost. And this total average total cost helps you to estimate that whether the company is increasing high cost or whether the company is increasing low cost. Now we move to understanding the term like marginal revenue, total revenue, and average revenue. When we say marginal revenue, suppose there is a construction of a building where the builder creates the first floor. The marginal increase is +1. Total revenue increases by 1. Then he again creates the second floor. Marginal revenue is +1. Total is 2. Third floor, marginal is +1, total is 3. Fourth floor, marginal is +1, total is 4. Right? And when you take the average of it, so for every creation of a floor, there is a cost of 100. So by creating fourth floor, the total cost was 400. So when you divide this 400 by 4, you get 100 as the average cost, and this average cost is your average. Sometime when it is getting making profit for you, it is average revenue, and if it is making expenses for you, it is average cost or average loss. These all terms helps you to identify the shutdown point. A shutdown point is the point where the firm just covers its variable cost. So if they keep on producing the units, automatically they will be getting bigger loss in the future. And here the company has to decide whether to continue with the same production of the unit or whether to stop. So this is the shutdown point. Every company, when they are not performing good and faced with some external problems like competition or a change of the customer tastes and preferences, has to face these two problems. Initially, every company faces the break even point problem. Break even point problem says where the firm is able to cover fixed and variable cost but the profit is zero. So it is basically a situation where we can say the no profit no loss situation, right? So below average total cost, right? What do you mean by average total cost? Average total cost says that when the company is keep on producing the output, keep on producing the output, the total increases. As we saw in the example of a building construction, the total increases, and when you take average of it, you get average total cost. So break even point is the point where the company is uh, generating income below the average total cost. So here they have to decide whether to continue, and if they continue, the variable cost increases, and if variable cost increases, they cover loss. So if they want to earn profit by removing all the expenses, they have to always earn through some or the other way, through marketing strategies or some or the other way. They have to attract the customers which produce above average total cost, so where the firm earns profit. So basically you have to understand these three rules. The first rule says always your revenue should be greater than cost, and if it is, you have to keep on producing. If your revenue is less than the cost, stop producing, otherwise your variable cost will increase, and when the variable cost increases, you have to face the problem of shutdown point. So when revenue and cost both are equal, or we can say the no profit no loss situation, you are facing this break even point as a problem, where this is not a problem. Actually, here you have to take the decision whether to continue with the production or whether to stop the particular production of certain thing and move on to the some other aspect which is more, preferred by the consumers. So I hope I was able to solve all these problems related to it. One last point: break even point is also known as IC, that is indifference curve or indifference point. So it is a point where it is called indifference because the firm is indifferent between producing and not producing in the long run. Thank you so much.